Hello, it's Chew Dog Charts. Now today, humor me for a moment. Let me read something to you. Life invests itself with inevitable conditions, which the unwise seek to dodge, which one and another brags that he does not know, that they do not touch him. But the brag is on his lips. The conditions are in his soul. If he escapes them in one part, they attack him in another more vital part. If he escapes them in form and in the appearance, it is because he has resisted his life and fled from himself, and the retribution is so much death. That's from Ralph Waldo Emerson, titled Compensation. So what does it mean? Well, let me interpret it this way for you. Bonfires are fun to watch, but eventually they burn out. So let's take a look. All right, here's one bonfire for you. Now this chart's pretty straightforward. It's the outstanding credit as a percentage of GDP, or essentially a measure of how leveraged the U.S. economy is. I apologize for the blurriness, but I'll try to point some things out here for you so you can get a better understanding. This shaded area is basically the normal range from about 130 to 170%. Again, 130 to 170% of GDP is the normal credit market debt. Moving back here from 1870, we come to the first peak, which was the stock market crash in 1929, and it reached a level of about 185%. Subsequently, during the Depression, it came and it peaked here in 1933 at 299%. Now, this point here was as much a function of the low GDP during the Depression as it was the actual credit. Now, it declined here through 1950s, 60s, 1970s, but then about 1980, the credit started to climb. And here at this point, 1987, in that stock market crash, the level was 230%. Here in the 2000 stock market crash, the leverage was 275%. And then in the 2008 stock market crash, the level was 371%. Now it peaked here, and has taken just a little bit of a decline. But the measure now is still more than 350% of GDP. Also, consider this. Consider what the chart doesn't show. Many of the individuals and businesses carry no debt at all, or certainly less than 350% leverage. That means many others must be leveraged far higher. That's a bonfire that will eventually burn out. Now, I don't want to be known as a perma-bear. I consider myself a contrarian. Essentially, a contrarian is an investor that believes success lies in going against a crowd because the crowd is usually wrong. But what you have to do is pay particular attention, not necessarily to what the crowd says, but to what the crowd does. All right, this is another bonfire. This is the cash allocation as measured by Merrill Lynch and their clients from 2005 to 2017. And as we can see here with another blurry chart, back in here, mid-late 2007, right before the 2008 crash, Merrill Lynch clients had roughly 11% cash allocation. The average is here at about 13%. Again, 11% right before the crash in 2008. Then at the very bottom in early 2009, February 2009, they raised cash to 21% of the allocation. Again, this is at the wrong time, raising cash at the wrong time and depleting cash down here in 2007 at the wrong time. Where are we today? Here in November 2017, the level is 10.4%. Again, 10.4% of cash allocation of their portfolio. I'm thinking they don't have enough cash. So again, let's pay attention to what the crowd does, not to what they say. So here, just in 2017, let's consider this. The Bank of Japan and the European Central Bank bought $2 trillion of assets. That's in 2017. Global debt rose above 225 trillion to more than 324% of the global GDP. U.S. corporations sold a record 1.75 trillion in bonds. European high-yield bonds traded at a yield under 2%. Argentina, who's a serial defaulter, sold 100-year bonds in an oversubscribed offer. The state of Illinois, who is near being insolvent, sold bonds to bondholders with a yield of 3.75%. Global stock market capitalization skyrocketed by 15 trillion to over 85 trillion and a record 113% of global GDP. The market cap of the FANGs increased by more than 1 trillion. Again, all in 2017. And lastly, the S&P 500 volatility dropped to a 50-year low and the Treasury volatility to a 30-year low. I'm a contrarian. I hope you are too. Let's go to the next chart. Consider this chart, which is from 2007 and forecasting into 2022. Hopefully it's a little more clear so you can read, but I'll show you what the main components are of the chart. The dashed red line is the Fed balance sheet. The orange line is the Fed balance sheet as forecast. And then the black is the S&P 500. The green is the S&P 500, but during quantitative easing. And you can see here when the balance sheet increased during this period here, then the S&P 500 also climbed during this point here. With the next quantitative easing in this period here, then the S&P 500 also increased, followed along in the increase during this period here. And then the third quantitative easing occurred at this point through here, and then the S&P 500 followed along on this trail. Now, we haven't had any quantitative easing from this point here, and then the S&P 500 went on a skyrocket and still is. But pay attention here. This is the Fed forecast on the deleveraging. Their forecast is for the slight deleveraging and then to have a continual deleverage for a number of years. So, although correlation isn't necessarily causation, I think you can come to the conclusion here that the Fed easing and then the S&P 500, which follows in an increase, there's pretty good correlation, and you may even say causation. If so, what's going to happen here during the deleveraging? Let's take a look at another chart. And coming to our last chart, or should I say the last bonfire, as of today, December 12th, 2017, Bitcoin officially becomes the biggest bubble of our lifetimes. And in fact, it may be the biggest bubble in history. I'm not sure of the exact closing price, but based on this chart by convoyinvestments.com, this is the peak of Bitcoin, starting in about 2014 to today. And if you're familiar with history, the tulip mania from 1634 through 1637 measured at this point here. So Bitcoin is outpricing the tulips. Now there's many other famous bubbles shown here below, including today's S&P 500, the Great Depression, Japanese stocks, the financial crisis of 2006 through 2009, and others. But now officially, Bitcoin has become number one. And that's it for today. For Chew Dog Charts, I'd like to say thank you. But before I go, please remember to subscribe and hit the notification bell for any new videos. Thank you.